core part of the IBD methodology is being able to assess when a market correction begins a new rally attempt. IBD has a set of rules and procedures for assessing market conditions and being able to identify whether a new uptrend is underway or not. So, why should we care about this? Well, it's very hard to buy stocks with any success when the market is in a correction. According to decades of IBD research, 4 out of every 5 stocks follows the overall market trend. So, you don't want to buy at the wrong time. Buying is best when we're in an uptrend. For IBD, knowing when we're in an uptrend starts with being able to identify a follow-through day. This key day can signal the end of a market correction or pullback. Follow-through days are also important because they often mean investors should begin raising exposure to the market again. But what exactly is the best way to buy on a follow-through day, especially since they don't always work out? To help me explain all of the important rules and tips for buying on a follow-through day, I'm going to turn things over to Justin Nielsen.
Yeah, getting back to basics, with a follow-through day, what we're looking for is, kind of 2 points, right? We start with a rally day, and then what we want is another point that we can look at where it shows strength. And Bill often used follow-through day and confirmation day interchangeably. In its essence, it is a confirmation of the strength that you got on your initial rally day. 1982 was a very clear example of there was a rally day that we noticed that he counted as a rally day, but it was a day that ended negatively. And so we said, okay, well, we have to count maybe some of these, what we call pink rally days. Yeah, go to the Dow. If you look in August, that's 769.97. So what we're looking for is after that rally day, we're looking for the confirmation day on day 4 or later, and you want to see that sign of strength. And so we got that. You see the first blue day, okay? That was allowed to be counted as a follow-through day because we had the start at that pink rally day. So that was the clear case of where you kind of needed that. And look at what happened after this. I mean, it was a really strong market to be involved in. Now, you have to recognize that this is not the way it's always going to go. That's not always going to be like you get the follow-through day, the birds come out, start singing, and the sun starts shining, and everything gets merry. Sometimes what happens is you get multiple follow-through days. Go to 2022. So go ahead and change that to March 4th, 2023. In 2022, as we were below the 200-day moving average line, we had a lot of follow-through days along the way. And you got a little bit of a rally, but it just didn't last. It was very hard to make much money in these. And so
Mhm.
you might have gotten tossed a little bit to and fro. So that was a difficult market. And that does tend to happen when you're below the 200-day moving average line, where there can be a lot of failures. You get kind of these multiple waves down, and then finally one of them works. And that's kind of what happened. What was that, January 6th, if I remember correctly, in 2023? Yeah, right there. That was your day, where you had a follow through day, and that is kind of what started the market. And even that one, it didn't, just go up straight immediately. It did have a pullback. So that's what we're looking for. So the next question is, when you get a follow through day, what do you do? Well, something I learned very early on in 2001, 2002, a mistake that I made was I kept on going in super heavy as soon as the follow through day happened. And what you actually want to do is you want to start buying, but you don't want to buy everything. You need to kind of go in incrementally. And that's why when we were doing the market school, we kind of came up with what things will get you in a little bit more and what things will kind of tell you to back away. So one of the things that'll get you in a little bit more is, oh, you're above the 21-day moving average line. You're trending above the 21-day moving average line. You're above the 50-day moving average line. You are having subsequent follow-through days. So the power that you saw on the follow-through day, you're kind of getting another one of those days. So now you're kind of getting multiple points that are showing on an uptrend. So those are the things that we look for as confirmation that you can, put more money to work. And look, it's not just about the market itself. It's also about the merchandise that you have available in individual stocks that are setting up in bases. And this is what tends to happen as these follow-through days occur, you want to look for stocks that are setting up, stocks that are looking good. You want stocks kind of more broad-based that are showing up with strong fundamentals, sound bases. In addition to what the indexes are doing, you also have what the stocks are doing, how they're reacting, and you know, we always kind of defer to our portfolio because if you have stocks that are, triggering sell signals, you're gonna want to react to that and back away quickly. That's the market giving you feedback, and it should not be ignored. When you're looking at the indexes, again, kind of relying on market school rules, you have when the low of your follow through day gets undercut, that's an early warning sign that hey, this one might be a failure. But the ultimate failure is when you undercut the lows of your rally day. That's kind of your line in the sand. When if you cross that, you no longer have that line intact showing an uptrend. Once you cross below that, that's where you reset things. And that's what we've seen a few times here. We've gotten our rally day, but the low hasn't held. And so that's where, hey, you're basically saying, okay, this rally attempt didn't work. And if you didn't get in at all because you were waiting for the follow through day, you save yourself a lot of grief. And a good example of that is 2020. You had some phenomenal up days. And if you were trying to chase every up day and say, oh, I've got to be in because, the market is up so much, well, it was followed by some of the worst down days. If we went with the orthodox methodology, again, what would Bill O'Neill, the founder of Investors Business Daily, do? He would never do an index. He's like, why would I want to water down my results? He was always looking for what stocks are leading, and that's where he would go. And then again, he's getting feedback from the market to go in more if the stocks are working, if more stocks are breaking out. And you really do in the first few weeks get this window of where a lot of the best merchandise will come out. If you look historically, it's not that everything comes out because you still do have stuff that'll come out like a month or two later, but a lot of the best performers will be in that first, let's say, 10 to 13 weeks of the follow through day. That's when they're breaking out, and a lot of them in the first 4 weeks. So Bill's thing was to always look at what stocks are leading. Let me get into those. He'd look at the relative strength, look at the ones with the strong fundamentals, and that's where he would gravitate. I personally have found success with sometimes if I'm not sure what stocks to get into, I will get some exposure, increase my exposure with index funds, specifically TQQQ, using leverage to get a little bit more exposure that way. And then if I see more and more stocks, I'll start selling some of my TQQQ to fund some of those additional purchases in individual stocks. So that's one way to do it. Sometimes there's so many stocks to choose from. I'm like, you know what? I can't even bother with TQQQ. There's just I want to be in all these different stocks, and I'm, trying a few different ones out. And then the ones that work, those are the ones that get more money. Where do I come up with that money? From the ones that aren't working, the ones that are, just not doing much of anything.